Thank you for tuning in to our quarterly webcast for second quarter 2022. I'm Jordan Kahn, Chief Investment Officer at ACM Funds, and let's get into it. The question that everybody's asking right now is, are we in recession? We've actually heard it referred to as recession obsession. And so we know that in Q1 of this year, we already saw one negative GDP print. So the question is, are we going to see a second one, right? Because the technical definition of a recession is 2 quarters in a row of negative GDP or GDP contraction. So if we look at the Atlanta Fed estimate for a gauge of how Q2 is shaping up, we can see that growth estimates continue to come down. Recently, they came all the way down to 0, and they continue to be lowered. So it's very possible that the Q2 GDP number could be a negative number, which would mean that we're actually already in recession. And if that's the case, it might explain why the stock market was so weak in the first half of this year, because it may have been reflecting, that we're already experiencing these recessionary conditions. If we don't see a negative print in Q2, it's also possible that we could see one in Q3, which, even though it wouldn't be back-to-back quarters of negative GDPs, we would still kind of see 2 quarters of negative growth, which for us, we would call a technical recession, let's call it. So if you listen to Janet Yellen, who spoke recently, she said that there's nothing to suggest a recession is in the works. That's what she said earlier this year, which kind of made us chuckle. It actually made us go back and look to another famous quote from Ben Bernanke back in 2007, when he said, "We do not expect significant spillovers from the subprime market to the rest of the economy or the financial system." And so we know, with the benefit of hindsight, that that quote from Bernanke back then was spectacularly wrong. And so I guess time will tell if Yellen's quote from this year is equally off base. So we know that what's causing all of this weakness and the Fed to start hiking rates really aggressively is this large spike that we've seen in inflation recently. This chart shows the spike in CPI that everybody is familiar with at this point. But it's what's causing all of the consternation in terms of this cycle and the Fed having to raise rates to kind of deal with this multi-decade high that we're seeing in inflation. So we thought that this cartoon was pretty funny because it shows, the Fed, who finally has woken up to now getting serious about inflation. The Fed has said that they don't expect inflation to be transitory anymore, that Powell said it's time to retire that term. And so now the Fed is finally getting serious. And I think the risk is that the Fed may be actually too serious about inflation, and that they're getting more and more aggressive with their rate hikes as the economy is already slowing down. So they're kind of hiking into recession. And I think that that's probably a high likelihood of what we're seeing playing out right now. If you look at kind of the longer term projections for the Fed funds rates, the FOMC themselves see the Fed funds rate getting to 4% in 2023. It's currently closer to 1.5%. So that is, a huge jump from here and a number of rate hikes to get us there. I think that it's unlikely that we see the Fed funds rate get that high, only because by then the economy will likely be in recession. And at some point, if the economy is weak enough, the Fed's going to have to pause just so they don't make things worse. So in terms of the economy, looking at the consumer, the consumer is the most important component, as the consumer spending makes up about 70% of GDP. So if we look at the personal savings rate kind of as a measure of the consumer's current propensity to spend, we see that there recently, in recent years, when the Fed was sending, or not the Fed, when the administration was sending out all the stimulus checks, we saw these big spikes in the savings rate as the money came in. But what happened is it looks like consumers were quickly spending that money. So now we've seen, as the stimulus checks have ended, we've seen the savings rate come all the way back down, and it's currently back at its lowest levels since 2008. So certainly, inflation played a part in this, in that the prices that consumer was paying for everything, keep going higher, and that kind of exacerbated this trend. So what did that leave consumers to do? If consumers are running out of their savings, the next thing that they do is look to use credit, right? So never underestimate the Americans' propensity to put things on credit cards. We know that, all this talk of the economic reopening and the desire for all the consumers to get out there and travel and, start having experiences and stuff like this again. So it looks like, at least recently, that they've been putting all of that on credit cards. If you look at this chart of consumer credit, you see that consumer credit is back at all-time highs. So that's a trend that likely can't continue for long, and really kind of lends itself to this notion that the consumer could be tapped out. Also, the labor market has been strong, which has helped consumer confidence at least stay relatively high, but we're starting to see layoffs creep up as well. This chart is actually for new startups layoffs. And so we know, in recent years, startups have had a ton of free money from the capital markets, whether it was private equity or IPOs or SPACs or what have you. There's been a lot of free money around. And so as that is starting to dry up with the weakness in the markets, we're now seeing that layoffs are picking up in the startup space. But it's not just there. We're also seeing more and more companies start announcing layoffs of their own. I made a little list of companies that I've seen recently announcing layoffs, and it includes the likes of Peloton, Carvana, Coinbase, Redfin in the real estate space recently announced. Actually, Wells Fargo and JP Morgan both said that they're going to be implementing layoffs in their mortgage divisions. We also have seen larger companies like Netflix and also Tesla have all announced layoffs. So this is, a trend that's likely to expand as the economy continues to weaken. And so it's just another thing that bears watching in terms of as it relates to consumer confidence and consumer spending. Turning to the stock market, one of the things that has been benefiting or acting as a tailwind in the market for many years now is all of this quantitative easing that's been going on, or central bank liquidity. And what's interesting is in this chart, they overlay all of this central bank liquidity, right, which is essentially growth in the money supply. So they're overlaying growth in the money supply with the increases in the market caps of big tech companies. And you can see that there's been a really, really strong correlation between quantitative easing and the increase in valuations in large tech companies. And so now we know that QE has stopped and we're just starting to get into QT. And so the question that kind of remains out there is, does this reversal in QE start to reverse this overall trend also? Meaning, is QT going to continue to cause valuations to contract? I couldn't resist putting one more cartoon in here. This one is of Powell, going for his guns, both of them at the same time, and it made me think about how the Fed tightening this time around is really a double-barreled tightening, in the sense that it's not just rate hikes that are going on, but it's also quantitative tightening in terms of the Fed's balance sheet. And so it's also not just here in the US. This chart shows that the rate hikes and the quantitative tightening that's going on is actually global in nature. And if you look at the percentage of rate hikes so far in 2022, it's actually back all the way back to 2008 levels. So, we're seeing central banks around the globe increasing rates and talking about reversing all of that, extremely accommodative monetary policy that has existed for many years now. I was just alluding to the fact that multiple compression has kind of coincided with QT and the rate hikes and inflation. And so what we see in this chart is that the forward PE ratio in the S&P 500 started the year around, let's say around 21, and it's come down all the way down to around 17. So we've seen pretty big multiple compression so far. What we haven't seen yet is what often happens in the next leg of the correction, and that is earnings estimates coming down as well. So if you look at this chart, you can see the red line is the S&P 500, which has already started to come down, in earnest. But the blue dotted line is the forward earnings estimates for the S&P 500. And we see that those are still in an upward trend. They haven't even started to come down yet. So there's a bit of a discrepancy here that probably can't last for too long. If we look at next year's estimates as an example, we see that the most recent estimate for 2023 S&P 500 earnings is actually higher than it was in the beginning of the year and over the last few months. So as we get into Q2 earnings season, this is something where we think we're likely to start seeing the beginning of downward revisions to earnings estimates. And here, this chart shows that these negative EPS revisions that I'm alluding to are actually just getting started. So that's what could cause another leg down in the market, we think, is that the first leg down has mostly been driven by a contraction in valuations and PE ratios, but that the second leg could coincide with if we see overall earnings estimates start to be revised downward. And in terms of consumer sentiment, we still think that there's room for this to get more negative as well. There are some indicators out there that are already showing a lot of bearishness, such as the AAII survey of individual investors. That's one that's showing a lot of bearishness. But this is a pretty good one. This Citigroup panic and euphoria model that takes a number of different areas of the market into account, whether it be credit spreads and things like that, how much people are paying up for put options and the likes in terms of hedging strategies. And if we look at this panic euphoria model, you see that it hasn't even moved down into the panic area of the chart yet. So still think if there's another leg down in the market, that could bring about more bearishness, and we could see this move down as well. How far down do we think that the market could go? Again, this is just a guess, but if we do a simple Fibonacci retracement on the market, so Fibonacci is something where you look at a recent low to a recent high level in the market, and then it gauges these different percentages about how far back things might pull back. Fibonacci levels are seen in all sorts of different cyclical areas of the economy, as well as the markets. So in this case, if we look at the March 2020 lows to the recent January highs, we can see that the market has already pulled back to the first level of the Fibonacci retracements. If we got to a full 50% retracement, that would take the S&P down to about 3,500. And there is possibility if we got down to a full, what they call a full 62% retracement, that would take the S&P down all the way to 3,200. So for the market to get down to 3,200, I would expect to see the PE ratio on the market come down a little bit further than what it is. I just showed that it was around that 16, 17 level. We could see that coming down a bit. And if earnings estimates get revised down also, then if you have a lower multiple on lower earnings estimates, that's how you could test some of these lower levels. I'm not saying, we're not putting this out there as a prediction or saying that it has to happen. I just think it makes sense to know, what some of the downside risks are in the market. And for us, because the market has been in a downtrend that's been so pervasive, and we've seen all this weakness, we continue to, err on the side of conservatism and be very defensive in our portfolios. In both of our funds, we have, in our equity fund, we have nearly the maximum amount of hedges on currently, so very little exposure. And in our tactical income fund, same thing, we have very little exposure and a high level of cash, that we're just waiting to see more signs of a more durable trading bottom put in before we start looking to put some of that money to work and trying to take advantage of some sort of trading bounce that could ensue. And with that, that's all we have for today. If you have any questions about anything that we've covered, please email them to us and we will certainly get them answered shortly. Thank you.